Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I'm gonna show you a fundamental analysis valuation on Disney stock, okay? So Disney, ticker symbol DIS, okay? So leave me a like if you find this video interesting and subscribe to the channel. Let's begin. I don't know if you saw the previous videos. I did a sort of fundamental valuation on Facebook, Carnival Corporation, and Delta Airlines. So go to check those videos out if you haven't already, and let's begin with this one. Now, before we start, let's take a look at the fundamental balance sheet, okay, of Disney. So to see if it's a stable company, if there is some danger, let's just take a look. This is the last balance sheet issued by Disney. So first quarter of 2020, okay? Let's take a look. We have a current ratio of 0.94, so it's slightly below 1 and could be better. Anyway, that's what we have. And the total assets and total liabilities, the ratio is 1.85, okay? So it's very great in this case. Debt to equity ratio is below 100%, 58.44%, okay? So is Disney too much in debt? Well, no, okay? It's fine. It's not few, but it's not too much too, okay? 58.44% debt to equity ratio. Market capitalization 211.8 billion. Book to value 2.23, okay? Now, let's take a look at the last 4 years for Disney. Revenues increased, especially since 2018, and earnings they went up and they went back down in 2019. Why? Because 2019 for Disney has been a year of investment. Okay, we are gonna see even later. Why? Because of the online movie business. So as Netflix, Amazon Prime, now also Disney has their own platform. Okay, so they had to invest to achieve that, and that's why in 2019 we are going to see the earnings and also cash flows were very low, okay, because of that. So let's go through the valuation now, okay? We have a lot of things to go through, so please pay attention to that, okay? This is slightly different from the previous model because in this one I'm gonna use the free cash flow to equity, okay? So I won't have to deduct for net debt because it's already the valuation of the equity itself, okay, and not the firm, the enterprise value. So let's take a look. Now the yellow numbers are past years, while the blue one are new years, okay, so estimates. Now let's take a look. To find free cash flow to equity, we have to take the free cash flow from operation activities and deduct the capital expenditures. Okay, so let's see. In the previous 4 years, those are the numbers and those are the free cash flows to equity. Okay, so consistently above 8, and here we can see 2019, as I told you before, we have just 1 billion, okay? Why? Because of these huge investments. But this year is, well, we cannot consider 2019, okay? Because it's a sort of an exaggeration, okay? So this is the truth, and this is a crazy years, okay? So 2019 is not useful for this analysis. It's useful to understand that the business has invested a lot, okay? So net income. Now, what we have to do, we have to estimate those free cash flows to equity for the next 1, 2, 3, 4, 5 years, okay? And how do we do that? Well, we estimate the revenues. And once we have the revenues, we estimate the net income. And once we have the net income, we can have an estimation of the free cash flow to equity. Okay, so that's what we are going to do. Revenues. Okay, revenues. Let's start with revenues. Those are the last 4 years revenues, and we can say, well, in 2020 they are not gonna make as much as they were making before. Okay, so why? Because of this problem, pandemic, everything is closed, and also the parks are closed. Okay, so let's say 65 billions in revenues. Okay, 2021, this is an analyst's data estimate. Okay, 79.56. And later we say, well, this is the first scenario. Let's suppose a growth rate of 4%. Okay, so for 2022, we are going to have 82.7 billion, 86 billion in 2023, and last year 89.49 billion. Okay, great. Now we have to find the net income. How do we find the net income? It's pretty simple, actually. We take the revenues and the net income for the last 4 years, and we are going to see the net income margins. Okay, historical one. And how do we do that? We take historical net income and we divide it by the total revenues, so that we say the percentage of revenues that becomes net income. Okay, so historically we have those kind of data. Okay, those kind of ratios. Now, to be conservative, I took the smaller one. Okay, 15.89%. And now we have the new estimates of revenues, and we multiply those numbers by 15.89%. Okay, and we get the estimated net incomes for the next 5 years. Great. Now we have to find free cash flow to equity. How do we do that? Again, we take the last 4 years net incomes and we do the ratio. Okay, so we do what? Free cash flows historically divided by the net income. Okay, and we get those percentages that are telling us how much in percentage of net income becomes free cash flow to equity. Okay, now again, 2019, I'm not going to consider this because it's just 10%, because the reason is the one I explained to you before. Okay, so I'm gonna consider these years. And to be a little bit more conservative, I took 75%. Okay, so 75% of net income is going to be free cash flow to equity. Great. Now what we do, we take those numbers here and we multiply them by 75%, and we get this blue line here, which are the next 5 years estimates of free cash flow to equity. Okay, so that's how it is. Now what we do, this is the first scenario. Okay, so with a 4% growth in revenues, we get those final free cash flows to equity. What we do, we put them back in the model and we see what is the price today. Okay, that's what we do. And so let's see the first scenario, the 4% scenario, which in my opinion is, well, the kind of bad scenario. Okay, not great scenario. The rate of return is going to be 9%. So this is like the cost of equity for Disney, and this is the rate of return that I would like to get from Disney. Okay, 9%. And the perpetual growth in this scenario is 3%. Okay, so with the terminal value. Now what we do, we take those estimations and we put them in the machines here, and so that we have those estimates and the terminal value that is going to grow at the 3%. Okay, great. That gives us a today's company value of 162.7 billion divided by the total amount of shares outstanding, which is 1.81 billion. We get a fair price of today of $89.89 for Disney. Okay, so this is the 4% scenario with a perpetual growth of 3. Now, what we do, well, let's see, scenario analysis. So 4% scenario, we have done it. Now we check 5% scenario, and you see that those cash flows are changing, and we copy them and we paste them in another scenario analysis, okay, in another discounted free cash flow valuation. And what we get, the 5% scenario, perpetual growth is 3.50%. Okay, now the 2 days company value in this case is 179.72 billion divided by the total amount of shares outstanding. We get a price of $99.29 as of today. Okay, now remember we don't have to deduct for the net debt because we are using the free cash flow to equity and not the free cash flow to the firm. So this is already the right value for the equity. Okay, great. Now another scenario, 6% scenario. Now we go there and again we change 6%, and again the rate of return is 9%, perpetual growth 3.50%. Today's company value 184.2 billion divided by the total amount of shares, fair price $101.77. Okay, now I forgot to tell you one thing. For those better scenarios here, I said, well, you know what? They're not gonna make 65 billion in revenues in 2020, but they're gonna make the one that analysts are predicting, the average, so 70.49. Okay, so I took a couple of scenarios with a lower value of this, okay, to be more conservative, because I don't like to follow all the times the average of the analysts. Okay, I like to take my numbers, and right now I put the average of the analysts back. Okay, great. So that we have the last two scenarios. This one is the same as the previous one, but I changed the perpetual growth. Okay, now we have 4%. Same process. The price that we get is $110.16. And the last one, the 7% scenario. So again, you go there, you just change this, a new number, copy and paste here. Requirements, again, perpetual growth is 4% and the same rate of return. We have a today's company value of 204.42 billion divided by total amount of shares, and we get a fair price of $112.94. Okay, with the 7% scenario, which in my opinion this is pretty optimistic. Okay, great. Now another valuation is given by the free cash flow yield valuation. What we do, as always, we take the 2021 free cash flow estimate, which in this case is 9.48 billion. We take the estimated cash flow per share by dividing this by the total amount of shares outstanding, and we get $5.24 per share as the estimated free cash flow per share. And we take the average free cash flow yield for Disney that over the last 5 years has been around 4.60%. and we divide this by 4.6%, and we get the fair price in 2021, which is $113.87. Now we have to push this back to 2020 so that we divide it and we discount it back by the same rate of return of 9%. What we get today, $100.06. Okay? So we take an average of all those estimates, fair values, and what we get that today the fair value of Disney is $102.35 per share. Okay, so when we go back to see Disney, we realize that Disney is now trading at $170.30 per share. What does this mean? It means that if you buy Disney today, you are not buying Disney undervalued. Okay, you are not getting a bargain in Disney. Today, Disney is a little bit overvalued. Okay, now bear in mind the meaning of this analysis is not to tell us am I going to make money in the next 5 to 7 years with Disney? Is Disney's price gonna be higher than this in the next 5 to 10 years? No, this is not what the analysis is telling us. What the analysis is telling us is simply that, given this future scenario, how much should I pay today for Disney? So that is what it's telling us. And it's telling us that today, Disney is a little bit overvalued because given all those scenarios, and if you take an average, today you should pay $102.35. Okay, but that doesn't mean that in 10 years Disney is gonna be $250 per share. Okay, it can be, of course, it can be. What this analysis is telling you is, today, am I getting a bargain on Disney stocks or not? Well, in this case, not much, okay? Because it's slightly overvalued. Great. So, I hope you find this video interesting and leave me a like for it and subscribe to the channel and leave me a comment below. Tell me what do you think and if you have done a valuation by yourself and what kind of price, fair values did you get, okay? So, have a wonderful day, guys. See you in another video.